Good afternoon, everyone. This will convene the meeting of the CERS Investment Committee. We have two significant items on our agenda this afternoon. One is a final review of our investment policy statement, and second is a staff recommendation regarding a real return investment opportunity. And that basically should constitute our activity for this afternoon's meeting. So we'll begin by the opening statement. And Patrick, I understand you will be presenting the opening statement. Please.
Yes, thank you. I'm standing in for Eric Bronco today. This is a special meeting of the County Employees Retirement Systems Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61.826. It may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you, Patrick. Sherry, would you do the roll call, please?
Yes, sir. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Dr. Milkman? Mr. O'Meara?
Here.
And Ms. Pendergrass?
Here.
Thank you.
Thank you, Sherry. So we can move on to the first action item for this afternoon. That's our investment policy statement. Just a quick review. At the last meeting, the investment policy statement was reviewed item by item and a number of issues, but basically resolved. This afternoon, we have the opportunity for some additional comments that Wilshire will provide to us, for which we've had copies of. So I'd like to turn the program over to David. If you would walk us through, I assume you're going to work off your one-page sheet. Is that correct?
That is correct. Yes, please, page 42. Thank you.
So, David, it's all yours. Please proceed.
Okay, thanks. Well, hello, everyone, and we were happy to be able to put a summary of these changes on this memo form, page 42, because there's a lot to it. And so if you've had a chance to go through the red line version, you've seen this, and then the clean version, obviously. So I'll just summarize a few of these. A couple of places in the section 1 introduction where some language has been strengthened. First paragraph under purpose in the philosophy section. A few references to other sections that tie into that one that we needed to clarify. Talked about the level of risk as being determined by the asset liability study, so clarified that a bit further from how it was worded in the past. And then also just clarify some of the language around the use of active management. So those are the key items in the first section, introduction. Section 2, under responsibilities. The large issue here is that the board intends to ratify decisions that are made by the investment committee. So that's been clarified in here. And also some roles and procedures around internally managed assets, some clarification on those in terms of responsibilities. Section 3, the asset allocation guidelines, the new targets that you put in place on July 1 are now embedded into the policy document. Language around funding and subsequent trading has been amended a bit. And then we have, in Section C, inflation protected assets, the real return section has been updated to remove language that previously had allowed for tactical allocation within here, which is really kind of a bit different than just a real return or inflation oriented investment. So that allocation or that language has been eliminated. And then finally, some cleaning up of monitoring benchmarks, et cetera, in Section 4, and timing around private equity and real estate have been cleaned up a bit. So that's the summary. There's a whole lot of red line in there that takes you through the weeds of this, and probably best just to stop there and see if there are any questions.
And David, just to add one more item that was not redlined in here, and we were looking for some direction from the investment committee relating to the co-investment policy.
Oh, good point. Thank you.
Basically, co-investments by nature have a relatively short window of opportunity. And given the fact the board wants to ratify decisions by the investment committee, we wanted to see how we wanted to proceed in allowing the CIO with potentially written approval from an investment committee chair and a board chair to be able to make these investments, or if a IC meeting and a board meeting are obviously within the window of opportunity, we can go through the standard presentation of investments. But if we do not allow the CIO to be able to make those investments with some type of approval at a board or IC level, there is the possibility that you would be sacrificing the ability to do some of these co-investment deals. So that's something to kind of open up to discussion for the committee today as well.
Thank you, Chris.
Are you talking about the language in section, I lost it, section 3D?
Let me move down.
I believe that is where it is, Betty. Yeah, that's what is referenced in our summary memo as well.
Yes.
Could you go over that one more time, just make sure everyone understands the issue that
Sure.
you're saying? Yes.
So, and Steve could feel free to opine on this as well, but many times when a co-investment is brought to staff, there is a relatively short window of opportunity for CERS to make a commitment to that co-investment. Many times that will not align with a standard investment committee or board meeting schedule. So if Steve and or staff found a compelling opportunity, they would either have to forego that investment if it didn't fall within the realms of a normal IC and board ratification, or if we were to write language in that would allow Steve to bring the opportunity to the investment committee chair and board chair, and if so approved, make that investment, would be kind of a middle ground, if you will. Otherwise, if the timing doesn't align and we are not able to, make an investment based on the meeting schedule, it would really mean that you might forego some of these co-investment opportunities based on that shortened window of investment period.
So it would be an exception as opposed to a general rule.
Well, we could write it in as a general rule such that if investment committee meetings and board meetings do not allow for a standard review and approval process, that the CIO could, via writing, get approval from the investment committee and board chairs at a specified amount to make that co-investment.
I think that would be appropriate, because otherwise, in effect, we're obviating the original idea of having those recommendations come to the investment committee. So this would be a general rule as opposed to an exception situation. So I think we might consider putting in exception language, and that would provide guidance to everyone if that could be done.
And that was our position. We wanted to open it up to conversation with the investment committee to make sure everybody was of the same mindset.
But right now, we do not have proposed language in this particular presentation.
Correct.
Can somebody give me an example of what we're talking about?
Sure. Yeah. So when you make an investment in a limited partnership with a manager, we'll say of private equity, buyout investments, et cetera, it could happen anywhere in the private markets. Often subsequent opportunities come where the general partner of that fund is offering the ability to let you co-invest in a particular portfolio company. So You've already invested with the manager. That manager has chosen that particular company that they've acquired, whatever that may be. And then sometimes there's an opportunity to co-invest alongside them directly in that company. That's what a co-investment is, and they're often, very, very good opportunities.
So it would not be
In the
a new addition.
Typically, typically it's one of a number of scenarios, and that's where there's the fund or the fund series that's investing in that opportunity doesn't have sufficient capacity, and so they'll offer it out to existing LPs. At times, even the funds, even if they do have capacity, it's an opportunity that GPs will afford to select LPs, a benefit of that relationship. That's often, as Wilshire mentioned, there's usually a fairly tight timeframe and turnaround once the opportunity is presented. As the language in the IPS indicates, those are typically done. The investment is consistent with the strategy that we're investing in already. So it's may not necessarily be a part of the existing fund, but it's consistent with the strategy. So to David's point, if it's a venture fund, it's a venture investment. It's not something completely different. It's also typically done on terms economic terms that are more beneficial than the existing fund investment. Oftentimes, co-investor done at no fees.
It would not be like a new fund manager that had gone through every.
no,
It's with an existing fund manager where we are currently invested, yes, and it's been through the approval and the ratification process.
So to answer Betty's question, then the language already exists in 3D. Like there doesn't need to be new language for that. Like that already allows it. Like we do that for Arctos, the sports fund that's been mentioned. Again, like Steve said, a lot of times it's something that they offer for investors, especially larger ones, because you are helping them out to get deals done. Either they, like Steve said, maybe it's there's more to do than they can do, or they have the capacity, but it would be too large of a piece of the fund for diversification reasons. So they can sell that they can offer it to their existing investors and still get the deal done. And then the existing investors get the benefit of more exposure at lower fees. So people kind of call it averaging down their fees or stuff like that. So we already have that in funds like the sports fund. They have invested in their Utah Jazz investment, the entity that owns the 76ers and Devils, and also Aston Martin Racing. That's already happened. So that's, again, they run that by us. I mean, there's some investors choose to just grant full discretion to the manager to add as they see fit. We at least, we have our managers talk to us about it, and we usually are going to go along with what, they obviously found a good, attractive investment and think it's, and think it's worth adding to their fund. So we're often going to do it, but there's occasions that we don't. But that's something that we retain as a staff. So this is existing language. I think it's just Wilshire's just clarifying that since your all's intention is to have everything be ratified, that additional process tends to delay things and then cause people to miss out. So.
Have we had cases where we've had missed investment opportunities because of the delay that was attributable to having to go through the original process?
So the current IPS does not require that. Mm-hmm. That's at the CIO's discretion. There have been we've had co-invest opportunities where we don't feel like we've had sufficient time to review it, and so we passed.
Okay.
And that's how quickly some of these get done. It's again, they tend to have very short burns, but the current language in the IPS does not require what Wilshire is proposing, either from a written approval or from IC approval, formal meeting, IC approval, and board ratification. So we have not missed out because of that.
To be clear, this is all about the consistency of the language. So right now, as Steve and Anthony have pointed out, the CIO has discretion on co-investments. In section 2, the responsibilities, we did update much of the language because of the indication towards us that the board wishes to ratify these decisions. This is more of a highlighted section that we wanted to make sure that the IC was aware of so that we can get direction on if we need to update any of the language as it relates to co-investments here.
And to be clear, our recommendation is not to update it, like to leave it how it is, because otherwise what Merle could suggest, or Merle was just asking about in terms of missing out, could happen. It doesn't happen now, but it could if this language is changed. Is what I think is being highlighted.
Well, it would seem to me that the compromise that maintains some consistency with earlier language in the investment policy statement, that if the two chairs sign off on the CIO's recommendation, then we have a thread of board ratification abbreviated for necessity of dealing with co-investments.
I would tend to agree with Betty, simply going back to Betty's original question. Yes, there is language in there. It's on page 13 of board books. But as Anthony pointed out, it is totally at the discretion. And what you've brought up is a perfect example of why I agree with Betty. First time I've heard anything about the Utah Jazz. So, you know, which goes to 2 or 3 of the issues that I still have with what I'm reading, one of which is with regard to communication and transparency. So in order to maintain that, I would certainly like to see language in there to where the IC chair and the board chair, and I would insert the CEO, would be informed, and you know, whether they've got approval or what, but they certainly are informed.
That is how some plans do it. They do it. It's delegated to their staff. I think we sent some of those examples out where some of the more leading Texas plans have done that. They've delegated investment decisions to their staff. Obviously, we're not talking about that in this case, but at least for co-investments, given the time frame, that is I think informing the chairs is probably a quicker way to do things to prevent missing out. But obviously, this is up to you guys. That's our recommendation, is to not do that. But you know, yep.
It's a matter of enhancing communication, I think, between staff and the board. So I think
But I think we have the quarterly meetings, and obviously any specials, we're happy to update you guys on the things that have been done. And we make several, but not lots and lots of decisions every year, at least in private markets. But we're happy to inform you of them to the extent that you guys are interested. But yeah, we've been in this fund for almost 2 years now, and so the Smith Entertainment Group, the Jazz, and now, well, they also bought an NHL team. So that has been in the fund. So we're happy to discuss that or any other investment in any detail that you guys would like. So.
Okay. Any other comments or questions?
Well, let me clarify. I think there's been a proposal for an approval by the 2 chairs, and then there's been discussion of informing the 2 chairs. So I think we need to decide at what level that transparency and informational process that we're comfortable with.
I'd also say that if you have a specific person, say the IC chair, that you want to have in the document, you need the ability to delegate that in the event that, say, Dr. Hackbart goes on a world tour vacation. We would like to have a delegate that he could assign that responsibility to while he's away.
I would be in favor. I would go ahead, Bill.
No, I defer.
I would hate for that decision to fall back on one person. So, I would, suggest language to the effect of approval of the IC chair and the board chair, and in the absence of one of those, the CEO be the replacement for approval.
Yeah. You could say, or designate board chair, investment committee chair, or designate.
Well, if we designate the CEO in the document, then the board chair or either one of the chairs who are not there, it's automatic.
I think in that case, we'd have 2 of the 3 principals. I think that would be sufficient. That we are not leaving it for one person to to approve or to be the recipient of.
Lyle, was that a motion?
Yes, ma'am.
I'll second.
Could you please restate the motion?
The motion would be language to be inserted in section D with regard to co-investment policy, that upon recommendation of the CIO to the IC chair and board chair, and in the absence of one of those, the CEO, for final approval of investment into a co-investment opportunity.
Okay. Is it clear for everyone? We have a motion.
Yes.
We have a motion and a second. Any further discussion? If not, all those in favor of the motion, please signify by saying aye.
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 Opposed? Motion carries. We'll ask Wilshire and the staff to make that adjustment in the policy statement. David, other items that you want to go through?
So that's it on the IPS. We can make those adjustments, work with staff, and unless you have other issues that you want to address now or later on the IPS.
Okay.
Mr. O'Meara has his hand raised.
Please proceed. Yes.
Yes, I would just like to include in the discussion the new requirements for making a selection. They're on page 24 and 25 of the board books. At the top of page 24 is the communication that is to be to the investment committee, and on 25 it's the responsibilities for selecting a new investment. So if we could just go over those so that they're in the body of the discussion today.
Yeah. Chris, would you like to review these two?
Sure. So if we could maybe go back to the first, the real changes here was to provide more of a process as to how investments will be brought to the IC. So first off, a recommendation by staff, obviously that comes with any new investment that comes in, but we're also going to ask the staff to outline where within the strategic asset allocation that particular investment will sit, the sizing of the investment, a summary of the search process and the details that were used, any criteria to screen a universe down to get to a list of final candidates, and then key risks, fees, liquidity, investment vehicles that will be used, all of the intricate details that would be involved in making an investment should be outlined as part of just a standardized document when bringing in an investment to the IC.
Is that helpful, Bill?
Yes, it is.
Okay. Any other final comments or suggestions?
Well, there's still the paragraph on 25.
Okay, yes, I'm sorry.
Okay, so we will conduct a formal search process documenting how the universe was narrowed. So this is kind of going through that one of those, I think it was item 3 in the prior page. This was something that I think in most recently some of the private investments, there's been commentary about having multiple options brought within a particular investment. And I think it's fair to point out that not all private markets are going to have peers that are actively raising funds to be able to compare side by side and allow the investment committee or the board to vote on a particular investment. So many times the IC and the board is essentially outsourcing the sourcing of deals, which is going to be done both by staff and by Wilshire for these private markets. So there will not always be a comparable universe for the investment committee to choose from or to see how a universe was actually filtered down to a particular investment.
Thank you. I just wanted to have that explained. in today's meeting since there had been discussions about it in the past. The only other thing, go ahead, Lyle.
Yeah, I want to go back to that. I certainly understand, and I'll use today's topic as an example. I could certainly understand where if you're sitting there and you're trying to evaluate a real return opportunity of not being able to find, 2 or 3 or 4 that are similar to today's, toll road option. But that doesn't mean there are not other opportunities within real return as an asset class that, certainly are worthy to be looked at and discussed. And to sit there and not bring those, or at least sit there and say, all right, these are the top 2 or 3 that we evaluated, and this is the one we like the best and why. But not providing that additional information on the other 2 really ties the hands of the investment committee. And, I just don't like that, it turns the question into a yes or no versus an either or. So I just wanted to put that out there because I think the investment committee and the board certainly want to see options, whether they happen to be a toll road in Texas or a toll road in New York or a, barge system on the Mississippi. I think they're all worthy to be evaluated on their own and to discuss how they fit in with one another from a risk perspective. Because that's the other thing that we're still light on in this IPS is the evaluation of risk and being able to evaluate that.
That sounds like we need to define what we mean by options.
Well, I found our next presentation interesting and informative because it did go through the other real return categories and made comments about whether they were viable at this time or not and whether they were currently under review. So I felt more comfortable that we as a committee understood some of the evaluation process and where we got to the one that is being recommended. And I felt like it did go and do some comparison, talking about timberlands or talking about whatever the category might be, and why we're talking about toll roads today instead of timberland or something else. So I felt more comfortable after reading the presentation that we're going to get next with this category. And I know we created a tremendous amount of angst in asking staff to bring 3 to us. So I don't completely understand that angst, but I respect the fact that it's a professional concern. I didn't want to draw a hard line today, but I felt that it was a discussion that we'd had in the past and warranted discussion today.
So in a sense, if we had X dollars to invest in real return assets, what we're basically, if I understand Lyle and Bill, what you're suggesting is a broader definition of comparables. So we don't tie down to roads versus roads or something of that nature, but other real return opportunities would be the comparison that would be useful to bring to the committee and to the board. Is that what I'm hearing?
Well, that's what I saw in the presentation that we're going to have next was why the other categories were not being recommended or came to the top as a recommendation. But now I'm speaking for staff, and I wasn't part of that evaluation. I'm just reacting to the presentation we have coming.
So the next case, the example of could be.
Sorry, go ahead.
Maybe it's the interpretation of exactly how what we mean by comparables.
And we've tried to address those concerns. Obviously, we've taken the feedback that we've received at prior presentations. And I'm actually a little surprised, Wilshire can comment as well, but typically what we see in, more sophisticated IPSs where they require board approval potentially is a distinction among search process. And you will see this when we have a public equity here in the coming weeks. Joe's close to finalizing a search in the public equity space. You typically have a distinction made between what the search process is between private markets and public markets. I'm kind of surprised Wilshire didn't highlight that in their IPS draft, because I know that's very common, especially with more sophisticated plans. Because you will see, specifically today, this is a continuation vehicle, so it's a one opportunity. We've tried to provide some background and color as to the things that we currently are evaluating or we have recently evaluated in the real asset space, but this is one that comes to the forefront and is an opportunity that's, again, there is a time consideration to it. They're in a raise period. There's, they're sourcing commitments. They're likely to be over committed in this specific fund. So there is a timing element to it as well.
Steve, I could add to that. To the point Steve is making about difference between private markets and public markets, there's a lot to that. And in private markets, there generally is, you can think of it as, we call it a forward calendar of investment opportunities, whether it's real return, private equity, etc. There's a sort of an ongoing calendar of opportunities that are coming at us that we may or may not consider. And I think that's kind of the issue here. We could probably shape some language to describe that so that when you are bringing an investment forward, maybe, this toll road isn't stacked up against other toll roads, but just like your presentation today gives some broader context for what you've been looking at in real return investments, I think we could come up with some language that references that. So you have some sense of, you have some context of the investment area where you're being asked to approve a particular recommendation. Steve, do you think that makes sense?
Absolutely. And I think, as you guys are well aware, in the private market, it tends to be, we think of a public market search as being a finite process, whereas the private markets are more of a continuum. As you've seen from the recent recommendations that we brought, most of these, even if we haven't invested with the manager, we've had an ongoing dialogue and relationship with the manager, often for multiple years before we ever consider investing in one of their funds. So it's not a finite start the process, finish the process. It's kind of an ongoing, continuing evaluation. And to David's point, then when our comfort and diligence meets the opportunity set of them raising capital, that's the point in time when we kind of dig deep and make a determination whether or not it's something we want to continue with.
Well, and I'll just add to that, because when we think about something like public markets, where it is very finite, as Steve said, and you can look at large growth, large value, small growth, small value, US versus non-US. When we think of private markets, you have all of those different components, whether it's sector, industry, country, region, but you also have vintage year, which makes it all the more complicated as well. So it is a continual, for lack of a better term, hamster wheel that staff is going to be on, trying to uncover and find best-in-class investment ideas in a much larger playing pool or sandbox, if you will, than just public equities. So there is a lot more complexity that goes on there. I think to Mr. Cheatham's point, it does make sense to think about how different investments interact with what's in the portfolio already, why it is a good fit for the portfolio. But to be able to say that there's 3 or 4 options within a particular time period, or perhaps saying this is why we selected this investment and we didn't focus on another maritime investment because we also have that in our portfolio already, is good context to bring to the IC.
Yep.
Strikes me what Bill has suggested is that the next item on our agenda is a good example of what is really being asked for in this case.
Yeah, that's right. So I suggest we can as a follow-up to this IPS, we could provide some language to clarify what we just discussed here.
Okay, good. I think you've got a sense of the concern, or not concern, but this.
Yep. Good. Mm-hmm.
So
Good feedback.
if I understand correctly, Lyle has asked, we're looking at paragraph II, and there's a new sentence language, mandate staff will conduct a formal search process documenting how the universe was narrowed to the top options. Lyle has asked for that sentence to be clarified to what could be included in options, and Wilshire has said they're going to provide some alternative language for that sentence. Is that correct?
Yes.
Good summary.
And if I could interject my last piece, on page 25 and on page 38, there were comments about a 15% cap on managers, and I just need to understand where we stand on that.
I'm glad
That's
you
in
brought.
statute. Yeah, that's in statute.
Well, I believe on page 38 it says 20% currently.
15% is the statutory limit.
Right. We currently have 10 to 20.
I'm looking at page 6, which I think corresponds to what you're looking at, Bill. I'm just looking.
And I may be reading it out of context, but just want to make sure we're not in violation there.
It seems to me we should keep the statutory language in there. On page 25, the comments are that it's unlikely that the passive investments would exceed that level. So it doesn't hurt to leave the statutory reference in there just for safety purposes. And on page 38, we're talking about active investment managers. I don't think we can change the, I don't think we can use 20% instead of 15% if 15% is what's in the statute.
I would agree with Betty in that we need to obviously maintain a level that's consistent with the statute. But if the statute, says 25, that doesn't preclude us from being even more restrictive. Number one, I just want to make that point. The larger point that we need to determine, and either determine it here or determine it elsewhere, is to what extent either of those percentages apply to internally managed assets.
And we may need a clarification there, because I'm not sure that was thought of when the statute was put in place, but I don't know that.
I think that's exactly right.
And those comments are on page 25 of board books.
This is Craig with Wilshire. Don't have my video on because I'm on the road. Apologies. Just want to point out there seems to be a small disconnect between this red line version and the clean, where those changes in the red line do not reflect what's in the clean version. So on page 17 of the board book, we can see that point that Bill mentioned that stated 10 or 20%, that is corrected to 15 to be consistent with the statute. And I believe, as Lyle was saying a minute ago, on page 6 of the board book, we also see that point about the 15% cap by statute is still in the document. So these changes in the clean, I believe, are consistent with the statute, and it's just an issue with the red line, maybe not being the latest version, but the clean version does keep the statute 15% in both of those places.
So what other issues in the red line version are not in the final version? That raises a distinct problem for me, because I'm looking at the red line version so I can see what changed. But if there's a different version for the final document than there is for the red line version, then we don't know what the changes are.
Well, shucks. Sorry about that, folks.
Good catch, Bill.
And we've gone through many iterations of this document over the past 4 to 6 weeks or so. What we certainly could do is use this as a commentary to bring back all the language. We're taking notes here, what needs to be input, and we can build a red line off of your current IPS versus what is going to be proposed, so we can tell the exact differences between the two.
That might be helpful. Yeah.
Old enough.
Because it sounds like we're going to have to, there are a few areas we're going to need to insert some more language.
Just so everyone's perfectly clear what's going to be in the final version, it might be good to do something of that nature, and also to fully appreciate the changes which are being proposed before we take the final vote.
So we could make what Chris just outlined, along with the other changes that we talked about here earlier, we could put into a follow-up red line.
They would be part of the red line components, right?
Yeah.
Right, okay. Anything else?
I'm going to follow Bill's lead on asking for some discussion for critical issue. On page 23 of board books, we've got some lengthy comments about the ratification by the board and how the IC interacts with the board. I'd like to have a discussion of those issues and how that links up with the notion that the IC committee now has technically a quorum of the board.
Well, I think the quorum of the board, I don't know if it was a private conversation or on air, but because this is I'm not a lawyer and I'm not at the Holiday Inn Express, but I understood that the quorum is for the committee. And so we're not in violation of anything, the fact that we have 5 people in a committee. I believe he researched that before we voted to expand the committees. So I don't think that is an issue anymore, but I'll defer to legal to comment further.
Well, I think we put some clarifying language in the bylaws. I'm just suggesting that maybe it would be helpful to have a similar statement in the IPS to be sure that somebody doesn't look at the investment committee and says, well, you know, there's 5 of the 9 there, so that's how the board ratified this particular decision. So I think I would suggest that we echo what the bylaws say about the notion that the committee has a technical quorum of the board, but it does not function that way.
I defer to law. I'm not sure that that wording is going to be appropriate, but we'll let them look at it.
We ought to be able to, I would think, just lift the language straight out of the bylaws and insert it wherever it needs to go, just for, you know, just for legal clarification.
Yeah, I'd be okay with that. The main question I had was this comment from HV. And it's a rather long comment, and if we could have an explanation of those thoughts.
Those comments are by Vicky, and I don't feel comfortable speaking for her, so perhaps that could be something that was spelled out differently or clarified at a future IPS review.
Well, I don't want to speak for Vicky either, but other comments deeper into the document say that they understood that management wanted the votes by the investment committee to be ratified by the full board. So I kind of thought that it was clarified what direction we were going as the comments progressed through the document.
So I guess you're suggesting, Bill, that any decision made by the committee then would be subservient to the board's decision, and therefore the numbers may not necessarily be a problem on the committee.
Well, I got confused in the last sentence in the comment. However, if the next CERS board meeting has a quorum of CERS trustees, 5, there will be a CERS board meeting, but the action of the IC cannot be voted upon because there are not 6 CERS trustees present. I don't understand that sentence.
There's language in here that it takes a vote of 6 board members in order to ratify any recommendation from the IC committee.
That's a good thing.
That requirement is in the IPS?
Yeah.
Do you know where?
Give me a second. I'm skimming through to try
Okay.
to see if I was just looking at it a second ago and clicked back on through.
It looks like it's in the bottom of page 22, board responsibilities.
Can you tell me the section?
Section 2, Part A. The CRS board shall require a vote of 6 trustees to ratify actions in the CERS investment committee.
Okay. That now it makes sense.
Are we okay there then, Betty? Are you okay? Are you comfortable
Yes.
with that clarification?
Yes, that's fine.
Okay.
But if Carrie doesn't want to discuss that issue of board ratification, we can put that on the agenda for the next time we look at the IPS, along with the updated comment.
Any other comments or suggestions?
Again, I'm looking at the clean version, which would be on page 7. Under H, item H, the last couple of paragraphs, in order to create an efficient and effective process, the CERS Investment Committee or CIO may, in their sole discretion, utilize an RFI or RFP third-party proprietary software or database to review existing service providers. I need a little clarification on the section where it just says in their sole discretion.
So that would be, as an example, Steve mentioned that we are doing a replacement search for the scientific beta, and we're looking at large core managers. That was at the discretion of Steve and staff to be able to use an RFI process to be able to solicit information from the managers that were screened from the broader universe down to a list of managers that I want to say was in the neighborhood of 8 to 10 managers to do further due diligence on.
Okay.
I don't think we would want to have a situation where Steve would need to come to the IC or the board to ask permission as to which form of solicitation he would go down.
Okay, here, all right, and I'm not disagreeing with that. I guess the door that I'm interested in making sure that is closed, because we are still paying for it. In with regard to how this relates to and I'm not sure what the dollar figure is. Ed, I'm sure probably can tell me. As far as spending money, you know, we got stuck with some kind of software database system that, as far as I can tell, nobody voted on several years ago. Not several, 2 or 3 years ago. that we continue to pay for to the tune of about $200,000+. I don't know if that went through an RFI or an RFP process, but you know, if we're spending money, I don't want it to be at the sole discretion of anybody.
I think that's the distinction that's covered in the procurement policy as to the approval required for expenditures of certain amounts. There's thresholds for where that is. This is really about which search process would be utilized. It's not about hiring any service providers or managers or consultants. It's just the process by which that search is done.
Well, you know, anytime you use a third-party proprietary software database, somebody's paying somebody for something.
So I think that language was included for the utilization of the Alborn database, research database, as well as not necessarily Solovis, which I think we're talking about, which is more of an RMS. But I think that means any either something that we're paying for from a consultant standpoint. You know, we have access to Wilshire's database as well that we can search. So I think it's about the methodology for the search process than
I just like, yeah, again, I don't have a problem with any of the prior part, other than just what I said when it comes to spending money. We're already paying for it. Use whatever the heck you want to use. But if we can tighten the language up to clarify that fact, you know, I think you could get away with it by, you know, using previously contracted third-party proprietary software database would satisfy my concern anyway.
It strikes me we might have gone as far as we can go today. My understanding is that our next step is we're going to have a clean version with red lines indicating the changes or adjustments which had been made or proposed and those which came out of today's conversation. Respecting the time for the day's meeting, I think there's a 3:30 meeting as well. And we have another item of relative importance on our agenda. So unless someone's like one final comment about this draft, I would like to move forward to the second item on the agenda so that staff has sufficient time to go through the recommendation and analysis so that we can possibly decide on that item this afternoon. Is everyone comfortable with that approach?
Absolutely.
Okay. So let's proceed. Let's assume that we'll move on to agenda item number 2 and turn it over to Steve, if you would, to
Thank you, Dr. Hackbart.
Presentation.
Appreciate the opportunity to present this investment opportunity in Project CERS, which is a continuation vehicle managed by Strategic Value Partners, obviously pending successful legal negotiations. SVP has successfully managed assets for CERS for almost a decade and currently manages over $150 million across the systems. Anthony's going to provide a lot of additional detail and color, but staff's view is this is really a unique investment opportunity in a scarce, hard to replicate asset with strong defensive characteristics that would be part of the real return asset allocation and would be shared among all CERS funds, pension, and insurance. When fully funded, this investment would represent approximately 35 basis points of fund assets. Obviously, that's going to be market dependent. And we would anticipate funding with existing cash or rebalancing from currently overweight asset classes. A little history: for several years, CERS portfolios maintained really a structural underweight to the real return asset class, as there was a lack of compelling investment opportunities, especially on a risk return basis compared to other asset classes. As the market has evolved over the last 2 years, especially the rate environment that we've discussed at length, the opportunity set has expanded and the relative risk reward for a number of real return investments have become more attractive. The real return landscape, as we've talked about just a minute ago, is very broad and encompasses a number of public and private asset classes. Staff focuses on sourcing in reviewing real return investment opportunities with compelling economics, favorable standalone risk-adjusted returns, low return correlations to the current real return investments and the broader overall portfolio. They also provide inflation sensitivity and meaningful diversification during periods of inflation, and additionally provide yield and current income, often from contractual cash flow streams. We view this investment as ticking all of those boxes. Currently, not accounting for capital already committed but not yet called by managers, the CERS portfolios are 300 to 350 basis points below their respective targets for the real return asset class. We are anticipating additional capital calls from current real return managers in the coming months and may have some interesting co-invest opportunities and opportunities to commit additional capital to existing managers. On a prospective basis, if we include that capital that's already been committed, and if we had it fully called as of today, the real return allocations would increase by about 150 to 200 basis points across portfolio, closing that gap to their targets. So even with that fully called capital that's already been committed, we have the need for committing additional capital. And Anthony's going to cover this exciting opportunity in additional detail. So Anthony?
Yes. Thanks, everybody. Can we please go to page 52 of the book, please? Okay. Like Steve mentioned, we've had money with Strategic Value Partners in 2 funds now. This asset, Project CERS, is in the first fund that we invested with them, Fund 4. They have owned it for about 7 years now. They were able to buy it, source it out of bankruptcy. It was owned by a European infrastructure player and financed by a lot of the European banks. There was a bit too much leverage used, also an interest rate swap that didn't quite work out so well. The manager or the investor or the owner of that got underwater, even though they had a very long concession with the state of Texas. So Strategic Value Partners was able to source a lot of the debt. And then was able to take control over it and emerge the asset from bankruptcy. And so in those 7 years, they've kind of done what they usually do. They change out the management, improve the processes. In this case, I think the previous owner had kind of strained relationships with the Texas Department of Transportation after a few years of maybe not doing the things they thought they should do. There was also a construction issue, like a actual physical construction problem that Strategic Value Partners remedied and actually clawed the proceeds to do that back from the previous owner. So those have all been done. The reason why they are interested in making a continuation vehicle now is because they still see some compelling growth going forward. As you guys probably know, the Texas region has been a very large growth area, especially in the past few years during COVID. As folks move from California, and just there's a lot of growth, both population and companies. This section of the road is between San Antonio and Austin. It relieves some of the traffic that is on I-35, and the value that it adds is basically the reliability of the reliability of the trip. Because I mean, I've made this drive before too. I don't have to, I didn't have urgent time considerations, but folks who are trucking or doing shipping in this corridor, which is obviously quite a busy corridor and growing. With more nearshoring and geopolitical issues with China, obviously Mexico continues to even be more of an important partner for us. So they're in a high growth corridor, and that has helped this road really perform. The SVP still sees further value to add, and this fund that they're in is about to be at the end of its life in a couple of years. So they are taking what would happen in this case is they would realize this asset by selling it to the continuation vehicle, which we are recommending investing with, because SVP is also taking all their proceeds and adding and putting it into this new vehicle as well, and adding some additional capital for a total of about $100 million that they are putting in. So again, eating your alignments there in terms of eating your cooking. There's also 2 other large anchor investors who are anchoring this continuation vehicle for about $500 million. So in total, it's about $600 million spoken for about $1.5 billion raise, or a little less than that. I think it's 1.2 funded. There's going to be some unfunded capital for other growth or other needs. So our recommendation is to is to invest in the continuation vehicle alongside our existing manager. We'll realize the small amount that we have in Fund 4 at over a 2x net multiple. So that I bet, and our proceeds, and we would recommend reinvesting that and also adding additionally to get the plans to another 35 basis points or so of exposure. So I'm happy to take any questions about the opportunity. Obviously traffic growth. I would say one thing: traffic growth, of course, is projections is a major concern or variable in which a lot of these deals hinge on. The people who did the study also did the study for our local Ohio River bridges here in Louisville. I think I talked to Ryan about it, and so we talked to the CERS as well to kind of understand their projections and how they've done over time in terms of just looking at our local example and also understanding what kind of the key assumptions are for their projections for this road. So that was part of our diligence that I think helped us get comfortable as well. Obviously, Strategic Value Partners done that, and quite a few other areas of diligence, plus owning it for 7 years. So there's been a lot of experience, and I think that there's a lot of alignment in terms of wanting to continue with this asset. We're viewing it as a real return opportunity. Like if there isn't that much growth and it just continues clicking along and raising the prices every November, that's fine. That could be projected at probably mid to high single digit return, which is very diversifying and appropriate in kind of a real return context. Strategic Value Partners and the other co-investor or the other continuation vehicle lead investors obviously believe that this is going to make more than that, significantly more than that. So if that happens, that would be great. But we view it as a good diversifier with a lot of contracted cash flow streams and reason to exist, and also scarcity. So.
And as Anthony mentioned, I think there's a very strong alignment of interest here. He mentioned that so this is in an existing SVP vehicle where we are invested. The GPs are not only rolling over their existing exposure into the continuation vehicle, but adding additional capital of theirs. So a very strong alignment of interest. And to the point of why the continuation vehicle, I think that's really predicated on their value creation plan that SVP has for the asset. Obviously they could take this to market, and there's some information in the deck on recent toll roads. That's not something that you see a lot in the U.S. It's more of a global infrastructure asset, but they're the multiples that you could see. So the realization, as Anthony mentioned, is going to be good for the asset within the fund itself. But the value creation plan that SVP has for this continuation vehicle has the potential to unlock a significant upside for the asset. So we modeled as a base case, in high single digits, which is really appropriate for this asset class. And where it sits in real return, and given its lack of correlation with our overall broader portfolio. So we view it as even modeled at a base case, it's an attractive risk reward, but with potential for pretty significant upside, given that, if they're able to realize that value creation plan, which obviously they're optimistic about, especially given that they're putting their own capital to work here. We see the upside, is a benefit for investing in the asset.
Questions, Steve or and Anthony, from anyone? Clarifications?
This is probably more clarification than anything else. Did I catch that you're explaining the breakdown of the money that you're wanting to put there? You touched on, cash on hand, money that needs to be readjusted from other asset allocation. And you mentioned existing dollars, so kind of touch on that and of this projected 7 to 10% net return, I would assume the majority of it is expected to be coming from income dividends, correct?
There is regular cash flow. I don't expect it to be necessarily distributed on a regular basis. That is their option of the owner, of course, but I think that there will be some. It won't be like a monthly thing, even though they're obviously collecting a revenue daily. Probably what will be more likely is that the asset will de-lever, and then they will do some dividend recaps, which they have done during their current 7-year hold. So at that point they just refinance the leverage since it goes down with all the cash flow, and then put on extra leverage and pay out some to investors. That's what we would expect to happen again in this case.
And from a source of funds perspective, so across the pension and insurance portfolios, there's cash available. We're talking about so there will be a minor realization. So this is an investment in an existing fund. When, regardless of if this continuation vehicle is approved or not, there's likely to be a payout from the existing fund as this asset is sold out of the fund into the continuation vehicle. But that's a relatively minor. So our recommendation is not only to roll that existing exposure essentially, but also increase, given that it's going to be a standalone continuation vehicle. The recommendation is about 35 depending on market value, about 35 basis points. So that can be accommodated through existing cash in some of the portfolios, where we're bumping up on some liquidity issues with some of the other asset classes. We would look to draw down where we're overweight, and specifically where we're overweight in a couple of the portfolios, public equities. We could draw down some of the public equity exposure, and again, we're talking 35 to 40 basis points of overall exposure.
Just to be clear, given our previous conversation, so to adjust our portfolio where we're overweight, that provides the funds we're looking for new opportunities, particularly in real return. We talked about whether or not there are other opportunities equivalent or better or not, so and maybe not match up with this particular opportunity. Could you talk a little bit about the search process, how you ended up with this particular option versus other options that might have been available for those funds due to their reallocation? To put this in context.
Sure, I'll start. Our starting point really is that, especially with the change in the IPS asset allocation targets that were approved and ratified, as I mentioned, most of the portfolios are currently about 300 to 350 basis points underweight to their real return target, closer to the bottom end of the range of the IPS specified range that's being approved or was approved. So we have a need for real return. So when we're looking in real return, and we also take into consideration on a prospective basis, if all the capital is called that we've committed to existing managers, but not yet called, that adds maybe 150 to 200 basis points across portfolios. So even with that committed capital called, we still have a need. So as we look across the landscape, as I mentioned, the most important things that we're looking for in real return asset classes are favorable standalone risk-adjusted returns, low correlations to what the investments we currently have in the real return portfolio, as well as to the broader overall portfolio. And as the IPS specified, this asset class is really supposed to provide some inflation sensitivity. So when we look across that landscape, and I think Anthony's deck does a good job of presenting some of the things we've recently looked at, and that includes, and I'll let him get into these, that the permanent crops, which was past global maritime, we looked at a dedicated commodity strategy, and then he has a listing of some other different stage evaluations that are ongoing, which includes infrastructure, energy credit, transportation, leasing, and mining credit. So I'll let him talk a couple of those. Would you prefer to talk about the things we passed on, the things that we're still interested in, or you can cover all of those more broadly?
I'd like to go back and address this cash flows before we get into the rest of that, if you don't mind. So you're asking for a total commitment of 60 million, correct?
Correct.
That includes what would be coming out of the existing investment.
So we're going to get that regardless, right? This continuation vehicle is whether we approve or not, they're going to sell this asset to the continuation vehicle. So there will be some monies that come back to CERS from the existing SVP vehicle that we're in. It's not nearly $60 million, obviously. But it'll be a small amount. In addition, so in order to fully fund a $60 million commitment, we would also use cash currently in the portfolios. And we would, where needed, we would also sell down overweight in other asset classes. And that would primarily be public equities.
You clarified that part of it.
Okay.
You know, I read through Anthony's deck on what they looked at, what they're currently passing on, and that sort of thing. If I'm correct, and I may not be because I may not have all the information, one of the other investments outside of the pro sports that we made back, what, 18 months ago, give or take, commitment wise, was to 175 million to CERS Farm. How much of that has been called?
None of that has been called.
So we've got 175 million. Why would we not use part of that money towards this? You know, we on paper anyway, seems like a better investment. You passed on another ag in when you were evaluating for this one.
So we expect the CERS farms to start calling capital. You know, that's an open-ended fund with an investment queue. So as that queue gets depleted, the investors move up in the queue. I think we're at the top of the queue now. Could be wrong, but are very near the top of the queue.
Yeah.
So we anticipate, you know, and again, that's as they see opportunity, and specifically for CERS, right, that they're buying ag property, so they're buying farm property. As they find opportunity to invest, they call the capital. So we anticipate getting capital calls from CERS certainly over the coming months and before the end of the year, which at that time we will also need to fund. So when that gets funded, we'll have to use existing cash as well as sell assets where we're overweight. So we would anticipate, and again, that's part of that 150 to 200 basis points on a prospective basis. That's committed capital that's not been called, and that's not just with CERS, that's Maritime, that's Arctos, that's other real return managers that we currently have. So we have, it's not necessarily all sitting in cash, right? We've allocated, we're overweight certain asset classes, underweight other asset classes relative to the target. If we were get all that capital called today, so we were to approve this, and we would also get ratified by the board, we would anticipate this capital being called pretty quickly, right? This is, given how this is going to work, it's going to be sold to the CV. It won't be one of our other real return managers where it's called in pieces over time. We would expect the majority to get called very quickly and be invested very quickly. As additional capital is called, as CERS calls, we'll have to either raise cash or use existing cash in the portfolios to fund those capital calls. I'm not sure if I answered your question, but it would, so it's kind of an ongoing rebalancing whether we have cash available. You know, cash is a little transitory in some of the portfolios, obviously, given the contributions and distributions that the portfolios see on a monthly basis. But I think currently we're sitting around 3% in cash for the pension funds, less for the insurance funds.
Our next regular investment committee meeting, Steve, do you mind to give us a breakdown of these real return assets as far as what sectors they're in?
Sure. I think if you actually turn to page 45 on the deck, this is the overall. I'm not sure if this was the end of August, which the data, I apologize, I didn't have a date on there. It may have been September 6th. So that on the left there is the overall asset allocation where we currently are. And as I mentioned, real returns target is 7%. Currently, that's invested. This is not on a prospective basis. This is actually invested 4% roughly across portfolios. And the breakdown of that 4% then is on the right. So this is the current real return allocation, which is, we have midstream, cash tied up in litigation, agriculture, timberland, barge leasing, infrastructure, debt, sports franchise, and then a very small runoff strategy. So these tend to be, the legacy end of life, waiting for the last realizations. We turn the page. I look at it on the graph on the right there is that if we were to fully call the real return allocation, Sherry, one page ahead, please. Thank you. As I mentioned, if all of the capital we've committed, so, was, we said series, we've committed up to 175 million. If what we anticipate gets called, and most of the time these don't call at 100%. Rarely do you see a fund called to 100%. Often, 90% called. We'll max out somewhere around there. So if all of our commitments were called today, we funded them, and we included that project CERS, which is this CV we're talking about. This is what the allocation of, let's say, roughly 7%, a little less than 7% of the overall fund would look like. So that the breakdown of that 7% allocated to real return would essentially look like that pie. So we still have a large percentage in that midstream. Significant portion still in cash tied up in litigation. But you can see from where we started, we're building out a portfolio that is much more diversified from a real returns perspective. When we started this process, we were highly concentrated in kind of midstream and cash tied up in litigation. So we've built out exposures to sports franchise, farmland, barge leasing, and we're looking here at adding to a toll road.
Just a technical note,
Sure.
I'm having a real hard time taking the legend and finding and identifying which color is which. I even went to full screen. I still can't see the colors. Like, I don't know what color Arctos Partners is.
Sorry, it's that having that dark background.
Yeah. Give up the dark
So
background.
Arctos is that green color.
If the next time you put this one together, Steve, if you would add the percentages to the legend, might be
Sure.
really helpful.
Absolutely.
Runoff strategies. I'm like Betty, I'm having trouble figuring out what percentage that is.
So the runoff strategies is essentially 0% in this graph.
That would be why I can't find it, right?
It's a very small sliver. If we look up above on the prior page, without the capital called or the commitment to this vehicle, runoff strategies is still right there. At kind of the 1%.
Okay. All right.
A table might work better than a pie chart.
Happy to try that as well.
I'll make a motion to approve the real asset investment as presented.
Is there a second, please?
I'll second it.
Okay. Motion's been made and seconded. Is there any discussion of the recommendation to accept the recommendation of staff regarding this investment opportunity? If not, I think we call the vote. All in favor of accepting the recommendation, please signify by saying aye.
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 Motion carries. Recommendation is accepted. Thank you, Steve and Anthony, for, I think, a really good presentation. Covered a lot of the topics and issues we talked about previously. So thank you very much for your hard work on this particular recommendation. Appreciate that.
Well, appreciate your time, appreciate the feedback, and we'll hopefully make the graphs look better in the next presentation.
Steve, if you got just one last question.
Sure.
I'm assuming in our contracts with these type investments, we've got some kind of timeline for them to be able to call capital.
So most of these funds have an investment period. So you have a period with which the funds, they have a period of time with which to deploy the capital, invest the capital, and then they have a period of time with which to realize or harvest the capital back. In this case, the term is 8 years with 1-year extensions.
I'm asking from the standpoint timeline from the time we make a commitment to the time that they call that capital to work.
So that is really only governed by the investment period, which can be extended. I mean, as we've seen with some of our managers, when we initially commit capital, there's oftentimes expectations as to how quickly it would be deployed. And one of the reasons why I think this is an attractive one is that, exactly to your point, this capital will be put to work immediately, or nearly immediately. And certainly in real return timeframe, this capital will get called quickly. There's typically in these not language specifically to how much will be called how quickly. It's more governed by how long they have to invest. It's what makes sometimes difficult when we talk about pacing. And as we've seen, it's on both ends. And Wilshire is still on, can weigh in on this. We're seeing the struggle on pacing is actually on the other side, the realization side, right? Everyone models pacing to how much we have to invest. Part of that is based on how much we're getting back from existing investments. So those pacing models have all been really taken a hit because the realizations haven't come back. There's frozen markets, and especially in private equity. And so that's led to a lot of frustration in the market. We've seen secondaries, we've seen interesting vehicle constructions, but I'm not aware. Wilshire, you may weigh in on this too. If you've seen much in the way of language of that, how quickly capital will get deployed.
I think you hit it, Steve. I don't think there's any clear numerical indication of that. To your point, we've seen the same in terms of distributions across private equity declining. We use DPI, distributions relative to paid-in capital, as our metric. We've seen those numbers continuously come down probably over the last 3 years, and then the average life of the vehicles has been stretched out or elongated somewhat as well. So yeah, to your point, I think that's a function of a slower monetization market. But in terms of calling capital for this investment specifically, we expect it to be much quicker than the average diversified vehicle, given they're ready to take ownership of this asset.
How long is our commitment for potential capital calls last? Is it indefinite? Something you negotiate?
Typically, that's governed by the investment period for a vehicle. So that investment period is the time with which they can call capital. After that, capital is not called. Yeah.
It's a 4 years in this time.
4 years.
And part of it is for their additional their value add plan is to build a connector, get a connector road approved, and then potentially extend the concession. So they require some additional investment, and so that is why they've given themselves more time. But most of this money will be deployed because it's consummating a transaction, right, between Fund 4 and this continuation vehicle. So it has to pay out the Fund 4 owners that are not rolling, and that's kind of where we'll go.
I think our time is about up. We have another commitment at 3:30. So if there are any really important questions, additional questions someone has or comments, I would like to bring this session to a close. Any final comments, concerns? If not, would someone please move to adjourn this meeting?
So moved.
Second, please.
Second.
All in favor, say aye.
All right.
Meeting is adjourned. We can move on to